Dear viewers, my name is Dr. Sharat Khandaka, and today our lecture will be based on the corporate governance. So before starting the lecture, let's look at the learning objectives of the lectures. The learning objective includes define corporate governance and describe its role in the successful reduction of agency problem. 2. Define the term captured board and describe situation in which a board is most likely to be captured. 3. Discuss the cost and benefits of having managers as shareholders in terms of proper corporate governance, and will also describe different types of act relating to the corporate governance, and will compare corporate governance practices across countries, specifically address the following: pyramid ownership structure, dual class shares, the role of employee in governance, and cross-holdings. The corporate governance and agency cost. So what is a corporate governance? We need to understand. So by definition, the corporate governance is the system of controls, regulations, and incentives designed to minimize agency cost between managers and investors and prevent corporate fraud. So this is a system to minimize the conflict between the managers and the investors in a corporation. So the role of the corporate governance system is to mitigate the conflict of interest that result from the separation of the ownership and control. As we know, in a corporation, the management are separate body from the owners of the corporation. By definition, the owners of the corporations are the shareholders, whereas the separate management has been chosen to run the company for smoother operation. So there could be sometimes the conflict between the managers and the owners of the corporation. So what are the importance of the corporate governance? So the number one importance for the corporate governance is the separation of ownership and control in the main important factor for the success of the corporate structure. So the main success factor of the corporation lies on the separation between the management and the owners. Second, the shareholder can diversify portfolio to reduce the risk. Now, which is another benefit for the shareholders because they can diversify the portfolio to reduce their own risk of the corporate portfolio. Third, corporate governance try to align the interest of shareholders and managers by providing incentives. Now, this is a big factor, and this is a big factor for any organization which do not want to create any agency problem. And the fourth is it also punishes the management for taking wrong action. So the monitoring by the board of directors. Now monitoring could be expensive and time consuming because the shareholders will be monitoring the board of directors. So the shareholders as a group elect the board of directors to monitor the managers. However, the directors might have conflict of interest among them because there could be different types of director in the board. However, there are some countries in the world, they do have different types of board of directors system. For example, think about the Germany. They do have two-tier board structure. So one is for the employees and another for the top management. However, most other countries give some weight to the interest of other stakeholders in the firm, such as the employee. So what are the types of director that we can see in the board of directors? Generally, research has categorized three different types of directors. Number one is inside director. Number two is gray director, and number three is independent director. So number one, the independent inside directors are members of a board of director who are employee, former employees, or family members of the employees. On the other hand, the gray director includes members of the board of director who are not as directly connected to the firm as insiders are, but who have existing or potential business relationship with the firms, such as the banks, law firms. And the last one, the independent directors are any members of a board of director other than inside or the grey director. So the board independence is a major key factor for the successful running the corporation. On a board composed of insider, grey, and independent director, the role of independent director is really that of a watchdog. So independent director is acting as a watchdog to monitor the organization. However, because independent directors' personal wealth is likely to be less sensitive to perform than that of the insider or the grey director, they have less incentives to closely monitor the firm. Now, which is another interesting factor, because as we have seen previously, that the grey director or the insider director, they do have some relationship with the firm. However, as the independent director, they are basically a watchdog and they do not have direct incentive to the corporation. They might not be always very keen to closely monitor the firm. However, the board independence sometimes could be captured. So what is captured? By definition, captured means, or it describes, a board of director whose monitoring duties have been compromised by connection or perceived loyalty to the management. Over time, most of the independent director will have been nominated by the CEOs. So over time, as we know, that the independent director might be nominated by the CEO, so the board could be captured sometimes. So the captured means that the board of directors whose monitoring duties has been compromised because of their loyalty to the management. So the independent director are the watchdog for the corporation, as we know. However, over time, the independent director could be employed by the CEO. Majority outside director, better for the corporation. Now there are extensive research that shows that when a company having a large number of outside director, the profitability of the companies goes up. C, independent board of director can fire CEOs. As we know, the independent board of director, they are not relying or connected with the board CEO or the firm CEO. So if they wish or they have the willingness power, they can actually fire the CEO. And there are also a large number of accounting research that suggests that appointing independent director can increase the firm value. So the board size and performance. So this slide will talk about the size of the board and the performance of a corporation. There are extensive research that suggests that when the size of a board is smaller, the firm can run more effectively. So research has found that surprisingly robust results that smaller board are associated with a greater firm value and performance. However, over the time, the board could be significantly larger. Now, that could be because of over time, long-running company, they might have large number of director, and after the acquisition of a target company, the number of board of director can increase as well. In this slide, it shows the board size and performance of individual studies. As you can see that there are several major studies shows that the board size and performance are statistically significant, and a smaller board could be more efficient and effective for running the company more smoothly. So what are the other monitors for the board of director, which includes security analyst? They produce an independent valuation report for the firm, so they are the monitors of the board of director. The lenders carefully monitor firms to which they are exposed as creditor, so they over the time they will monitor the board of director. The employees of the corporation, they will be the monitors for the board of director, and the Security and Exchange Commission. So these are the other monitors of the board of directors. So the compensation policy is the next slide. So the compensation policy can include stock and options. Managers' pay can be linked to the performance of a firm in many ways. For example, many companies have adopted a compensation policies that includes grants of stock or stock options to the executives. This grant gives managers a direct incentives to increase the stock prices, which ties managerial wealth to the wealth of the shareholders. In the USA, for every $1,000 increase in firm's value, CEO shares on average $3.25, and most increase come from the changes of the stock value. So the compensation policy for the managers is a good way of making sure that there are minimum agency conflict and the managers are working to increase the value of the company, which is aligned with the interest of the owners of the company. This slide shows increase in firm's value and the CEO compensation from 1970s till 2015. In this slide, we can see that the CEO compensation in millions of dollars of 2013 has increased significantly, and it is actually moving towards at the same direction of the company value. So S&P 500 index companies, when the company value is increased, the same times that CEO compensation has also increased, and it is statistically significant. So the compensation policy, which is a very good strategy for the owners of the corporation to make sure the management is working on their behalf. However, there has some negative consequences as well. For example, often options are granted at money, meaning that the exercise price is equal to the current stock price. Therefore, sometimes the manager have an incentives to manipulate the release of the financial forecast so that the bad news comes out before the options are granted, which drive the exercise price down. So the manager might can purchase the stock below the market price, and then the good news comes after the options are granted. Research found that this is a widespread practice around the world. Now this slide shows the CEO compensation and what are the different types of compensation policy. So the blue one is the cash, red one is the stock and option, and the third one, which is the yellow color, is the other option. And we can see that the CEO compensation has been increased year after year, and the cash and other options and stock and options are the major drivers of the CEO compensation. Stock option grant. Giving free stock option, for example, valued value of $1,000, which can be exercised with a reasonable time frame, say 2 to 3 years. It can have call and put option. Now this could be a stock option for the managers. However, the CEO can exercise the stock grant when the stock price is low and sell the stock price is high. And now this is one of the main reasons of granting the stock option to the CEOs. This is a very common types of instrument which is given to the CEOs, which is also practiced in Australia. However, the recent research has found evidence suggesting that many executives have engaged in backdating their option grant. Now, what is a backdating then? So the backdating is the practice of choosing the grant date of a stock option retroactively so that the date of a grant would coincide with the date when the stock price was lower than its price at the time the grant was actually awarded. So by backdating the option in this way, the executive received a stock option that is already in the money, so they're already having a gain. However, backdating is illegal, though it is widely practiced. This slide will talk about the managing agency conflict. Academic studies has found that the notion that the greater managerial ownership is associated with the fewer value reducing action by the managers. So if the manager is having a greater ownership of the company, they will take fewer action which will reduce the value of the company because they have their own interest on the company. Top management has higher ownership interest. For example, the Microsoft, they do not want to reduce the value of the company because of the higher interest of that particular company by Bill Gates. Higher managerial ownership will try to create more value of the firm and will take fewer action that will reduce the firm's value because the higher management has a strong incentives of the corporation. However, what are the ways the agency conflict can be managed or minimized? Now, there are several actions that can be taken by the shareholders, which includes shareholders vote. So, any shareholder can submit a resolution that is put to a vote at the annual meeting. Second, the shareholders approval. Shareholders must approve any major action taken by the board. Third, the proxy contest. Now, which is a different one and very interesting one. Unhappy shareholder can hold a proxy contest and introduce a rival slate of director for the election to the board. This gives the shareholder an actual choice between the nominees put forth by the management and the current board and a completely different slate of nominees put forth by the dissent shareholders. Interestingly, there are few research that has shown that announcement of the contest increased firm value by 8% on average. Now, why is that? When this news goes to the market that there will be a proxy contest on a particular company, it suggests that the shareholders are monitoring the company. So the value of the company increases. Now, this slide shows you the recent proxy contest and the outcomes. So the outcomes could be these four categories. One, proxy vote, descendant loses. Proxy vote, descendant wins. Other outcomes and settlement. If you looked last few years, the other outcome and settlement are the big factor. Because whenever there is a proxy contest, the management knows that the shareholders are not happy with the management decision or the way management is running the company. So they try to minimize the conflict between the shareholders and the management, and quite often the other outcome and the settlement are the major outcome for the contest. Management entrenchment. So large investors have become increasingly interested in measuring the balance of power between the shareholders and managers of the firm. Now, which is a major factor? The Investors Responsibility Research Center, or IRRC, has collected information on 24 different characteristics that can be entrench management, which includes poison pill, empty takeover status, staggered board, etc. So what is a staggered board? Staggered board is a system that the board of directors will be nominated every 12-month period of time. So rather than all the board of directors will go for an election after every 3 to 4 years time, rather than that, the board of independent director or the individual director will have the option, or they will be nominated for every year. So the changes will occur quite often. So what are the regulations of managing the agency conflict? So there are two major regulations that we're going to discuss in our lecture today. Number one is the Sarbanes-Oxley Act, or we'll say that SOX, and we'll also talk about the Cadbury Commission. Now remember, the SOX Act has been passed in the USA, and the Cadbury Commission Act has been passed in the United Kingdom. So the first one is Sarbanes-Oxley Act. So this is a US Act to protect the shareholders and board from providing a false statement or information by the top level management to the shareholders. The overall intent of SOX was to improve the accuracy of information given to the board and to shareholders by an independent in the auditing process, by stiffening criminal penalties for providing false information, by forcing companies to validate their internal financial controlling process. The Cadbury Commission in the UK, on the other hand, following the collapse of some large public companies in the UK, the government commissioned the Sir Adrian Cadbury to form a committee to develop a code of best practices in corporate governance in 1992. The recommendation of the Cadbury Commission are very similar to SOX Act in the USA. However, the SOX Act actually attempted in the US market after 10 years of the Cadbury Commission. So some of the suggestions were: CEO should not be the chairman of the board. Audit and compensation committee should be made by independent director. Auditors should be rotated. And the last point is there should be a fuller disclosure of the non-audited work. Insider trading. Now, when we're talking about the agency conflict, we also need to think about the insider trading. And what is an insider trading and why it is a punishable act in almost every country of the world. Some examples of insider trading includes knowledge of an upcoming merger announcement, earning releases, or changes in the payout policies. So insider trading is a punishable act in almost every country of the world, and the penalty can include jail time, fines, and civil penalties. The degree to which the investors are protected against exploitation of the company fund by the managers, and even the degree to which their rights are enforced very widely across the countries, and the legal reason. The degree to which investors are protected against exploitation of the company funds by the managers, and even the degree to which their rights are enforced very widely across countries and the legal regimes. Now, this table shows you the penalty of the insider trading or allowable sentences. Now, if you can look into the table, you can see Australia has 10 years sentences for the insider trading. That's the maximum allowable sentence. United States has maximum allowable sentences of 20 years. Hong Kong 10 years. Britain 7 years, and Japan 3 years. So it varies across the countries. Now, when we're talking about the corporate governance around the world, we need to understand the controlling ownership structure and the pyramid as well. Now, much of the focus in the United States is on the agency conflict between the shareholders and the managers. However, in many countries, the central conflict is between what are called the controlling shareholders and minority shareholders. And in these firms, there is usually a little conflict between the controlling families and the management. However, there are different types of structure or controlling structure of the ownership across the different countries. There are some research which suggests that the investor protection among the best in the USA and common law countries. However, when we're talking about the investors protection, communist countries provide very less protection to its shareholders, and French and German based civil law countries also do not provide sufficient protection to its shareholders. There is a very good literature which I would suggest you to go and read by yourself regarding the investors protection right across the globe. The name of the literature is called the Law and Finance. Please do a Google search and find out this article called Law and Finance and read. You'll find it is very interesting for your own understanding the corporate governance structure across the globe. Now, in some countries there are dual class of shares. Now, the dual class of share is a share that one particular class of share having higher voting right. For example, a class B share might have 10 votes for every 1 vote of the class A shares. So the controlling shareholders, they might have only few number of shares, but their voting right could be the largest in the company. Now, there are some countries where the dual class of shares can be easily issued. These countries can include Brazil, Canada, Germany, Italy, and some other European countries. And a pyramid structure is another way of controlling the owners and the pyramid. This structure can allow a small number of shareholders to control the company without holding more than 50% of the shares. For example, this is a way for an investor to control a corporation without owing 50% of the equity. In this situation, the investor first creates a company in which he has a controlling interest. This company then owns a controlling interest in another company. The investor controls both the company but may own as little as 25% of the second company. Now, A great example for this could be the Presenti company or the Presenti family in the Italy as of 1995. The Presenti family effectively controls 5 companies even though it doesn't have more than 50% ownership of any of the company. Now this slide will show the structure of the Presenti family in 1995, which is also called the pyramid structure. Now here is the Presenti family. They create a company A. They're the owner. They have the ownership of 29%, but they do have the voting right of 45%. Then they create another second company, which they have the ownership of 32% and the voting right of 54%. And the third company is that the ownership 62%. They also have the voting right 62%. So this is the way they created the pyramid structure, that one company has the controlling interest of the second company or the third company. By this way, without actually holding 50% of the company's shares, they might have only 25% shares, but they might have the controlling voting right more than 50% of the companies. Now the next slide is talk about the stakeholders model. The explicit consideration most countries, other than the United States, give the other stakeholders, which is, for example, the employees, to participate in the decision-making process. For example, in the Germany, having a two-structure board is a very common situation. In Germany, it also gives employee board representation. Some countries mandate employee participation in the decision-making process in their constitution, and also some countries have mandated workers' council or the local version of the labor union that are to be informed and consulted and major corporate decisions. In this slide shows the employee participation in corporate governance in OECD countries. You can see some countries the employee is appointed in some board as a board members, and in some countries the worker councils mandated by the law. So you can look at this name of these countries in OECD's countries. You can see what are the regulation of the corporate governance for them. The next slide will talk about the cross holdings. While in the United States, it is rare for one company's largest shareholder to be another company, it is the norm in many countries, including Germany, Japan, and Korea. In Japan, groups of firms connected through a cross-holding and a common relation to a bank are known as kiritsu. In Korea, for example, the Samsung and LG have subsidiaries and the group of companies in energy and telecommunication, and which is called the chaebol. So this is a cross-holding option for these companies. So the cross-holding is possible in some countries, as we mentioned in this slide, and which is a common scenario for different countries. So we are almost finishing our lecture. So the next slide is about the trade-off of corporate governance. Corporate governance is a system of check and balance that trades off cost and benefit. Now this trade-off is very complicated, and no one structure works for all, so different countries have different types of corporate governance structure. The cost and benefit of corporate governance system also depends on the cultural norms, and a good corporate governance is always value enhancing. Hopefully you like this lecture for today. If you like this lecture, please make sure that you subscribe to these channels, and thank you very much for watching this video.